A single investment bank can help a startup raise their first $1 million check. Alongside that, they can help government raise billions of dollars in funding. In this video, we will understand exactly how investment banks are raising money through equity, where we will understand the various elements like IPO, rights issue, private placements, and on the debt side, where we will understand various elements like bonds, debentures, syndicated loans, and much more. All of this with real Indian examples that you have definitely heard about. If you have ever wondered how biggest deals actually happen, then this video will make it crystal clear. Hello there, my name is Karan Damania. I am an ex-investment banker turned founder, and through encoding careers, we help you build successful career in finance. Let's get onto the screen and start understanding the elements of fundraise. Alright, so first we are going to start with types of equity fundraising. Here there are 5 options that investment banks provide to their clients. Let's see each of them one by one. First one is IPO, which is initial public offering. We will first see what that equity fundraising means, and then we will go on to looking at an example. So IPO is initial public offering when a private company lists its shares publicly for the first time. There are two types of company. One is private limited, one is public limited. When a company is private limited, it has limited number of shares and limited number of shareholders. Now, when a private company wants to raise more funding through equity, then it will go on to become a public limited company, and then it can have unlimited number of shareholders in its company. That's where to trade the shares of private limited company, it gets listed on a stock exchange. Now in India, there are two types of main stock exchange. One is BSE, one is NSE. Now there the company will list itself, and then the shares will be traded publicly and people can buy and sell that. So here investment banks help facilitate the entire initial public offering to private limited companies. Now let's look at an example. Here we have example of Zomato's IPO in 2021, where it raised over 9,000 crores with banks like Kotak, Morgan Stanley, and Credit Suisse acting as book runners. When a company wants to go and raise funds through an IPO, it needs to hire an investment bank to act as a book runner. Over here, book runner helps the companies raise the entire amount of funding that they are looking for an IPO. So in the case of Zomato, it is 9,000 crores. So investment banks will help to get that 9,000 crore of funding for Zomato through various investors. So that is entirely about IPO. Second type of equity funding is FPO, which is follow on public offer. Here, when a private company becomes a public limited company, it lists itself first time on the stock exchange. That is done through an IPO. Now, when a company wants to raise more equity being publicly listed, it then does a follow on public offer. So here, let's understand the meaning. When a listed company issues new shares to raise additional equity. So in follow-on public offer, they will have to issue new shares. Here, old promoters cannot dilute their shares and do a follow-on public offer. They will have to additionally issue new equity shares. Now here also investment banks are hired to get investors for the amount of funding that companies are looking to raise through an FPO. This is similar to IPO, but here the company is raising funds once again after an IPO from public. Here the investors could be institutions as well. Here looking at the example, we can see Yes Bank's FPO in 2020 raised 15,000 crores to shore up its capital after a crisis. SBI Capital and other investment banks managed the issue. So Yes Bank did an FPO in 2020 where it raised 15,000 crores because it was facing some crisis due to COVID and it was not able to manage its business. That's where it decided that it should raise funds through equity funding by doing an FPO. And here, when an FPO is done, the share price on which the equity is raised is at a discount of what it is being traded on stock market, because that is where investors will be more motivated to put funding or put money into that particular company. So that is about follow on public offer. The third one is rights issue, where existing shareholders get the right to buy more shares, usually at a discount. When a follow on public offer is done, it is not compulsory that only the current shareholders will be able to buy the shares of company. Anyone who wants to participate in FPO can do. But in rights issue, only the existing shareholders can get rights to buy shares. And usually this shares that company offers to existing shareholders is at a discount. Now here also companies are trying to raise funding through equity shareholders, but they are not trying to get investment from everyone in the market. They only want that current shareholders to put money into the company at certain discount levels. Now here it will depend upon the investor that they want to invest in the company or not. Initially, when this announcement is done, a right share is credited into shareholders account, but it will depend upon the shareholder if they want to get that right share converted into a full equity share. If not, then they can sell that out and get credited for that amount. So that is about rights issue. Here, taking an example, Reliance Industries 2020 rights issue raised 53,000 crores, the largest ever in India, with Axis Capital, SBI Capital, and others advising. Here, investment banks will help company structure the entire rights issue, how much should be diluted, at what price should the right issue be done, how much discount should be provided. All that decision is being made by the company and investment banks who are working together. Alongside that, investment banks can help companies to convince the existing shareholders to get participated in that particular right issue and help companies fulfill their entire funding requirement. That is how rights issue functions. The fourth one is private placements, where companies are raising equity privately from angels, institutional investors, or funds. Private placements can also be seen when a company does series round. So series round is also facilitated by investment bankers unless companies directly have contact with particular investors and no investment banker is in between. Most of the time when initial level of series round are done like A, B, then investment bankers won't be involved in that kind of round because the amount of funding raised is very much small and the fees that could be made on that kind of deals is also very small. They are focused on doing higher amount of transactions so that the fees is also justified and the efforts that they put in is also credited well. Now let's look at the example. Here we have Byju's raising multiple series rounds like Series F over $500 million, which was backed by big investors with investment bankers and advisors structuring the entire transaction. Byju's has not gone for an IPO and it has raised funding through series round only. Now, as mentioned that investment bankers initially don't participate in smaller rounds of funding like Series A or B, but when the rounds get bigger, then it gets investment bankers interest because the amount and the transaction value is also very high. As we can see for Byju's, it raised Series F with over 500 million of funding, which would be around 4,500 odd crores, which most of the company don't raise in IPO as well. So here, the depending upon the size, investment bankers will participate into series round or private placement. Now the funding can be raised through angels. Now angels come in at very initial stage of a company where it is currently in ideation or seed stage and does not have a very good business model ready. Because angels invest in a lot of company, they are ready to take that kind of risk. Institutional investors or venture capital or various funds will come into the picture when company has a certain business model defined, it has product ready to go into the market, and here a valuation multiple is set, and that's where a series round of funding gets started. The final one we have is qualified institutional placement, which is also termed as QIP. It is a quick way for listed companies to raise equity from institutional investors only. All the above options that we saw, like IPO, FPO, rights issue, it was offered to existing shareholders and anybody who wants to invest. But in QIP, only institutional investors. Now, institutional investors would be someone who has big money and they are very large corporations like pension funds, insurance companies who have amounts with them that they are ready to invest into companies. And here, companies target this institutional funding because they have huge amount of money and it is very quick in process. Looking at an example, we can see HDFC Bank's QIP in 2020 raising 15,000 crores with investment banks like BOFA, that is Bank of America, and JP Morgan. Here, HDFC Bank would have reached out to various institutional investors. It could be foreign companies, it could be in insurance companies in India, it could be pension funds, and there is variety of institutional that has funding available with them. So that is about equity fundraising. Next, we are going to understand the types of debt fundraising which investment banks are facilitating for companies. Looking at the first one, we have bonds or debentures. Here, companies raise debt from public or institutions by issuing bond. Now, in equity, we saw that a particular dilution is being done in the entire shareholding that a company has. But on the debt side, there is no equity dilution that happens for fundraising. Here, the entire amount is being secured by a company and they then need to pay a certain element of interest, follow certain clauses that are attached to the entire fundraising. In the bonds, companies are raising debt from public or institution by issuing bonds. Now, bonds is also a type of security. It is available on various platforms, but where it is not traded, but it provides particular amount of interest to the bondholders. Now, looking at the example, we have NHAI, which is the National Highway Authority of India, regularly issues tax-free bonds for infra funding, retail investors, and institutional subscribers via arrangers like SBI Capital. So, NHAI is a government entity which, on a regular basis, is issuing tax-free bonds for infrastructure funding. Now, government, when they want to do infrastructure funding, like they want to build a highway or they want to build a railway track, that's where they will need huge amount of funding for that. Here investment banks can help facilitate this entire funding by issuing bonds. they will have a coupon of around 7, 8 or 9% depending upon what is the interest rate going on in the market. And this entire bond is structured where then investment bankers will reach out to investors. They have institutions that they have connect with and facilitate the entire funding for government. Since NHAI is authority that takes care of the entire highway infrastructure, the funding that will be raised will be used for roadways construction. Second one we have is syndicated loans, where a group of lenders provide a large loan that a single bank alone wouldn't fund. Here, instead of doing bonds or debenture, the company is looking out to raise funds from banks. And if the amount of funding that they need is much bigger in size, then a single bank wouldn't take a lot of risk by fulfilling the entire loan. They would want some other banks also to come into the picture and then divide the entire loan amount. Here, investment banks are helping companies by reaching out to banks, facilitating this entire syndicated loan process. Looking at an example, we can see Adani Group secured a $3.5 billion syndicated loan to fund its Holcim cement acquisition. Banks like Barclays and Deutsche Bank arranged it. So $3.5 billion, which accounts to around 30,000 crores, is a very huge amount, and no single bank would be ready to fund that kind of loan. So here Adani reached out to Barclays and Deutsche Bank and asked to facilitate this entire fundraising through syndicated loans. So Barclays and Deutsche Bank would then further have reached out to various banks and then facilitated the entire $3.5 billion funding by dividing the amount between each of the bank. So it could be possible that a certain bank provides $1 billion funding, a certain bank provides $500 million, and the other would divide the entire rest amount between them. So that is how entire syndicated loan takes place. Here it would be investment bankers' duty to negotiate the interest rate, to get the entire documentation process done, to provide whatever information is required on the company to the bank. So that is how entire syndicated loan is being processed. Third one, we are going to see sovereign bonds. Now, government issue bonds overseas to tap foreign investors. As a country, to run the entire system, to run the government entities that we have, we need some funding, and that's where government issues bonds. Now, most of the time, when government wants to raise funding, it will reach out to foreign investors because the interest rate that the government provides on the bond is very much low and is similar to what banks would offer on FD or something. So for an example, if government wants to raise bond that has coupon rate of around 6 to 7%, it would reach out to investors in US where their interest rate ranges around 2 to 3%, and that is where the investors in USA would get higher interest rate by investing their money in India and getting 6 to 7% of interest. That is how investment banks will help government to facilitate the entire process of raising the bonds. They will reach out to foreign investors and help government in raising funds. Now the example over here is India's masala bond, rupee denominated bonds sold overseas, like the NTPC's masala bond issued arranged by Axis Bank. Over here, masala bonds mean that the bond will be issued in foreign country, but the value of the bond will be in rupees. And then there are various criteria of how the funding raised from masala bonds will be utilized by that particular entity. It could be to purchase a land, it could be to invest in capital markets, it could be to expand its business, and that are all the criteria for which masala bonds are issued. NTPC being a government entity, it raised masala bonds where the issue was arranged by Axis Bank. The final one we have is private debt, where the funding is raised from non-bank entities like debt funds, NBFCs, or private equity funds. Now, debt funds is something that all the asset management companies have in their portfolio. When we search about mutual funds into debt element, we can see a lot of schemes that invest via private debt. A private debt is something that companies are raising to facilitate certain kind of things, like to purchase a stressed asset, or to expand their business line, or to acquire a real estate. These kind of things can be done via private debt. Here, depending upon the need of the company, investment banks can help target the particular investors that would be suitable for that kind of funding. Looking at the example, Pyramid Capital provides structured private debt to real estate or stressed companies arranged by boutique investment bank. Investment bank can then tie up with Pyramid Capital, and when they find certain kind of leads who are into real estate or are currently stressed companies, then they can reach out to Pyramid Capital and get the entire funding done. So that is how the entire debt fundraising part works. Now let us understand how investment banks are earning fees through this entire fundraise process. Number one, we have upfront fees, where investment banks are being paid for the deliverables like information memorandum that they are creating, the investor deck, the due diligence support, the roadshows that they have to function. On the equity side, all of these deliverables come into the picture because investment banker needs to create an entire storyline. They need to do all the due diligence from the investor side. They need to facilitate the entire road shows, for which lot of meetings are being done with the investors, with the clients, and here investment bank then take an upfront fee. It could be certain crores of rupees, it could be certain lakhs of rupees, depending upon the size of the deal, how many people will be involved in that particular transaction. So here Zomato paid multiple investment banks to prepare its IPO book and pitch to investors. The next one we have is a success fee, which is a percentage of the entire amount raised by a company. The typical success fee ranges around 1 to 5% for big equity or debt raises. It is more for smaller private placement. As we mentioned earlier that when a company goes for funding, when the size of the funding they want to raise is smaller, the investment banks will not have a lot of interest into it because they are putting a lot of efforts to facilitate the entire process, and the funding and the success fees that they will get to facilitate the entire transaction will be very much small, and that is where they charge higher for smaller private placements so that the entire efforts are being paid well. It ranges around 1 to 5% for big equity raises or debt raises. So for an example, we have given a boutique investment bank helping a startup raise $20 million may earn a 2 to 4% success fees. Now, when the entire $20 million is credited into the company's bank account, the company has then responsibility to pay the investment bank 2 to 4%, whichever is being negotiated during the deal. If it is 2%, then the company would have to pay around $400,000 to the investment bank. So that is how the entire success fees is being calculated and becomes a revenue for investment bank. The final one is retainers, where some investment bank charges monthly retainers during long mandates like M&A or debt restructuring. Debt restructuring is where first the entire debt that currently companies have on its book is paid by raising new debt at lower interest rate. And that's where investment banks are helping the entire amortization of the current debt amounts. How much should we pay initially? How much should we keep on books? And how much should we raise? That is a long process that takes time, and investment banks will then charge monthly fees from the companies so that the effort that they are putting towards the company for entire debt restructuring can be capitalized. And on the M&A part, a particular M&A deal will go around 6 to 8 months, where a lot of due diligence takes place, a lot of meetings, negotiation between the two companies takes place, and investment bankers have to be part of it. It becomes easier for investment bank when a company pays them retainer basis so that they are not dependent on the facilitation of entire transaction, and either ways they will earn a good amount of revenue through the deal. So that is how we cover the entire equity and debt fundraising elements, and we saw how investment bankers are earning fees through the entire fundraise process. All right, so now you know how investment banks are helping companies and governments raise huge amount of funding through various elements of equity and debt. If you want to understand how investment banks are getting these kind of leads, then check out this video. It will help you clarify the same. So that is it. See you in the next one. Until then, this is Karan Damania taking your leave.